our cutting-edge technology and collaborative client-focused brokerage team to provide the highest level of professional service at all stages of our clients' investments. Our team has decades of experience in all types of markets, guiding clients through some of the most challenging times for investors. Our all-hands-on-deck approach generates more offers on your listing, and according to CoStar, we have sold our listings faster and with the highest list-to-close percentages over the past 2 years. For buyers, we identify and negotiate the best terms possible, ensuring your long-term success. We hope your time with us today helps your passive investments become massive investments. Centennial Advisors, here for you now and always.
Good afternoon. I'm Justin White, Managing Director of Centennial Advisers. And thank you for joining us today for Centennial's Making Sense of the Election webinar. It's November 12th, 2024, 7 days after Election Day, and we are beginning to have clarity on how the outcome will influence our clients. Today, we'll cover topics from a national perspective, as well as some of the most local results. Those local results will directly impact a few of our clients, but oftentimes are the leading indicator of legislation and ordinances that will affect a larger portion of our clients over time. Throughout the rest of the year, we will continue the series of webinars featuring Centennial's local experts and the impact on the elections will have on all of their clients. Today, I'm joined by Don Shalom, our market leader in rent control multifamily assets in Los Angeles, and we'll discuss whether Prop 33's failure to pass is the end of the rent control battle for owners in LA and surrounding cities. After we talk to Don, we'll be joined by Daniel Rowland, a leased investment specialist. We'll cover the outlook and impact of the elections results for our office, retail, and industrial owners. Before we head to Orange County and are joined by Regional VP Mike Alper, who will discuss the impacts of election results in Orange County, including Santa Ana's Measure CC and the impact of housing costs on both for sale and rental housing is having on turning more and more voters blue when it comes to housing-related issues. And we'll finish with Tom Watkins, who over his 20 years in the industry has completed transactions across the country. The results this election will have far-reaching impacts for California-based investors as more and more see the growing divide between California and the rest of the country and redeploy capital into areas that have better growth prospects for business owners and landlords. Don, thanks for joining me. What would have happened to values in LA if Prop 33 had passed?
Well, the simple answer would be look at how valuations involve market rents and the upside potential of a property. And so most people would argue that it would have decimated values by, who knows, 25, 30, maybe even 50%. Because how can you see value in something when you're that restricted? The only upside would have been removed, basically.
So it certainly seemed like over the last few months, the fear of how big of an impact it would have had on values saw a significant drop in transaction activity. Talk a little bit more about that, what you were seeing, what you were hearing in the months leading up to the election.
Right. So, I mean, there's definitely been a large disconnect between sellers and buyers in the LA, real estate market. Going back, obviously, when rates started to climb up, I think it became a big deal. We started to see things start to make sense to a smaller group, but there was definitely a lot of stalled transactions, a lot of what we call the squeeze put on the sellers before contingency removals, et cetera. But as we got closer to the election, I think we saw a bigger disconnect due to uncertainty. And I think uncertainty has caused a lot of the stall here recently.
Well, let's talk about that because in Prop 33 failing to pass for the third time, certainly we might see it again. But we know interest rates had certainly a large effect on the gap between buyer and seller and what values are. But just specifically, about how long before the election did the potential of Prop 33 passing have a very strong impact on that buyer-seller disconnect? Was it? It certainly seemed like it was much more than 1 month. It might have even been 9 months to a year.
Yeah, I would say we started to see a lot of reports around June or July, but as it got closer, within 90 days, I would say it got really intense.
So it seems like coming off of that, we saw, I believe it was, I forget the first number now, but back in 2018, basically repeal of Costa-Hawkins made an appearance on the ballot. It appeared again in 2020 and then showed up in 2024 again. And really, from what you're saying, sounds like had an impact on the entire year. So at least 6 to 9 months before the vote, it was already affecting property. What maybe advice do you have, or what do you think people can learn from the fact that it's been on the ballot 3 times and might be back again, and kind of a strategy or how to handle this a little bit better?
It's a great question. It's probably difficult to answer only because while it did not pass, many people might feel like they've dodged a bullet. It's really temporary. When we look back to AB 1482, I think that was put in place just after the voters voted no on one of the previous measures. And so most people would argue that Los Angeles, Southern California as a whole tends to implement some of their own decisions regardless of what the voters say. And so I think right now, in the anticipation of the potential of more restrictive measures coming, it's important for owners to look at optimizing, property management and their efficiency. Maybe there's ways to cut some unnecessary costs and just try to kind of keep the value as close to the potential, sorry, let me say that a little bit better here. There's ways to cut costs that they need to be focused on. There are things to implement within the property as far as certain upgrades that may justify higher rents, such as value-add renovations. But overall, I would say the largest percentage of stock that we have in LA is obviously under rent control, pre-1978 construction. And we're seeing with the rising costs, especially with insurance, that most owners holding onto their properties are in for a lot of updates. The major components need to be updated less than 10 years. So electrical, plumbing, roof, gas lines, those types of things.
We'll come back to those in a second, because I think you said a couple of things, whether it was ways that people can cut costs, upgrades they need to make pre-1978. You mentioned insurance. Like, there's a lot of proactive ways owners need to get themselves caught up or ahead of the game, because although Prop 33 did not pass, the LA City Council came out, endorsed Prop 33. Certainly, I think the city feels very empowered to take a much more aggressive position on how much owners can charge, what they're allowed to make, if they get the opportunity again. Talk about what are some of the ways owners can cut costs and increase NOI and therefore strengthen the value of their property.
I would say energy efficiency is one key ingredient to cutting costs. Perhaps solar installations might be something to look at. There's definitely amenities that could potentially be added or maybe subparceled out in leases, looking at how your leases are structured. Those are all going to be important to the NOI, to the bottom line.
You talked about upgrades. Talk about that for a second. You obviously talked to a lot of owners that were planning for the worst case scenario of 33 passing. And one of the strategies is through upgrades, getting your rents as high or as strong as they can be. And you mentioned separating some of the items. What upgrades were you hearing that people were doing that were the most cost effective, best ways to do it? And then talk a little bit about splitting the leases to give yourself, I guess, flexibility to move the income stream where you can.
Right. So I would say that unfortunately, a lot of the upgrades that are being implemented right now are not necessarily going to attract the tenants, although they may have a relation to that. For example, when it comes to updating electrical, if I'm a tenant and I move into a unit and I can't sustain, computers and all sorts of different electrical appliances going on in my unit, I might be quickly out of that apartment into the next one. And so by updating electrical and focusing on sustainability and different other types of things around the property, you can attract tenants, but you're also going to offset the insurance cost, which I am hearing from most owners is one of the biggest concerns right now.
So talk a little bit about that. I mean, you do a number of transactions. You've already mentioned insurance a few times in this conversation. What is the reality? Because I think a lot of owners want to believe that their insurance is going to be the same because they didn't have any claims, or that they're not going to see the significant increase that maybe peers have. Talk a little bit about both of those things, whether it matters if you have had no claims in the pricing of your policy now, and or are there any ways to keep your insurance cost where it is today and not see it triple?
That's unfortunately what we're seeing, and I'm hearing from a lot of owners who, for the last year or even longer, we've been advising to be prepared for this. It's coming. We've heard from insurance vendors. Many insurance companies have been leaving the state of California altogether. We've had clients who've owned buildings for decades that have never had any claims that are being canceled, not even renewed. And then when looking on the market for new insurance policies are being forced to do updates before they even get any quotes. And I'll give you a quick case example. We have a client who on a smaller rent controlled asset built in the 50s or 60s had been, like many people, paying under $3,000 a year to insure the property, a 6-unit building. And last year, the renewal more than doubled. She ended up paying closer to $7,000 a year. The property is under contract right now, and the new buyer's gotten a couple of quotes, and the best quote they've got on that same property is $20,000 annually. So the reality of where things are going in the insurance market, from what we hear, is that even if you think that you're insulated from that because you've had a great relationship with your insurance carrier for the last however many years, I don't think that you stand a chance to stay away from it happening. It's coming.
So there's certainly just, what are the options? Either pay the higher premium. Is there the option of just paying the higher premium versus doing retrofits to some of these major systems?
So I think that it's going to be required to do a lot of updates and retrofits regardless. I think that I think you almost have to separate that insurance cost and recognize that there might be ways to pass through other costs to tenants to be able to kind of offset that. What I mean is, maybe implementing RUB systems or different utility bill-back systems within the property to offset, because I don't think you're going to get around the insurance going up.
When was the last time you had a transaction where the insurance amount wasn't a sticking point in the negotiations or contingency removal? And what I mean by that is, when was the last time the insurance is whatever it is, it's an unchanged expense, I can budget that, versus where it's always talked about and pricing or a request for credit, insurance has been the justification for that?
I think it's prevalent in every deal right now, simply because most deals we see out there on the market have not yet had new quotes applied to them. And so often the cap rates that we're seeing are based on the insurance that was paid by the seller last year or this year. And every circumstance that we're in right now, we have multiple escrows right now that are dealing with insurance /update costs, and those are becoming sticky points for contingency removal.
I think one of the things that owners probably just need to accept as a reality of this is that when there is a transactional opportunity for the insurance company, it is a new client. There's not the long-standing previous relationship on this particular property. So they maybe have a little bit more freedom or ability to mark that insurance to market. Right. And that just needs to be accepted, and it's part of pricing today. And some owners are looking out of state because things may be cheaper. There may be more consistency there. Now, the last question I'll ask you, because you mentioned two things. One, if it's more than 10 years old, and then you also mentioned 1978. Talk a little bit about what you think is in store for apartments built prior to 1978 in LA or in areas of LA County that are under rent control.
I would say the biggest concern for owners of older RSO properties is really coming down to the condition of the, as we talked about the different, systems within the property. There's talks right now of LA County voting to restrict rent increases another % or 2. And so I think overall, the concern that most owners should have is that when you're looking to make any sort of move right now, whether that be, finding a way to diversify your portfolio through an exchange or by other means, is to recognize that sellers are in a place today where they need to compete more so than they've had over the last decade with low interest rate costs. And so I think the majority of stock of inventory that we have is obviously rent controlled RSO properties, and so they're all in right now in line to update, upgrade, find new ways to manage the costs that are associated with the property, and then recognize whether they've reached a point in time that it's worthwhile making those concessions in a sense, or if it's time to move on to other potential ways of making money.
I said that was going to be your last question, but I actually changed my mind while you were answering.
Okay.
And I want to ask you this because a lot of our comments, and we've spent a lot of the time on what is 75 or 80% of the apartment ownership group right now. Private client owns a couple properties, used to operate from a position of partnership with the tenants, and now it's a totally different ballgame for those sort of owners. But there is still opportunity, and every apartment building in LA is owned by somebody. Where do you see the upside or the opportunities in your market for somebody that operates in a way that allows them to be highly profitable under the current rules?
So if you're thinking long-term, bigger picture and investing in Southern California apartment buildings, I think the benefits we have come from the fact that we do not have a lot of new supply. And so we have that supply demand. So for the long-term investor, I think there's definitely going to be upside. How we see value add buyers right now analyzing deals is such that they're eager to see these price per pound overall reductions in the market. And so they're figuring out that sellers are starting to meet the market in some cases, but we still have a lot of supply that hasn't moved yet. And so there's definitely, I think, still a little bit of immediate concern among most investors. But overall, I mean, we're in Southern California, and any point in time we look at 10 years later, we seem to see that rents are higher and values have gone up.
Fantastic. Well, thanks for your time, Yadon. What we're going to do right now is we're going to take a minute, but for everybody who's listening, feel free to use the chat if you have questions for any one of the guests today regarding a specific situation with your property or just a general question that you'd like the audience to hear their answer to. Please use the chat. We'll get set up in about 30 seconds, and we'll be joined by Daniel Rowland to talk about some of the things that the election's impact on owners of leased investment. Welcome back, everyone. I'm now joined by Daniel Rowland. Daniel is a leased investment specialist out of our Long Beach office. And we're going to talk to Daniel a little bit about what we see about the election of Donald Trump and at least on the federal level, a very Republican, let's call it maybe business friendly outcome of the election. But before we get into maybe what, America First policies look like, from the federal level, we'll talk about a couple things that have happened in California just prior to the election that we think are notable and that owners need to be aware of from a valuation and what their long-term plan should be standpoint, but also just managing through the nuance of it with their properties. Daniel, let's start with AB 98 that passed at the end of the legislative session. Tell us a little bit about that.
Yeah, so AB 98 imposes new development standards for warehouse and logistics based on the warehouse design, location, the parking, the loading bays, the landscaping buffers, and the entry and internal circulation of the trucks on the property.
Okay, and there's a part of that is something called a sensitive receptor. You want to talk a little bit more about that?
Yeah, so the requirements for the project go off of what they're dubbing as sensitive receptors, the size of the project, and the existing zoning on site.
Okay. So are some restrictions on what you can't do or have to do when there is a new development. Also talk about that, because I think that long-term, that's going to have an impact on the rent growth and the value of these investments.
Yeah, and just to go back to what the sensitive receptors are, there are 6 total. So it's going to be residences, preschools through high schools, daycares, parks and recreation areas, and nursing homes and hospitals. So a part of that goes into the breakdown for these developments. So they have them based off of 250,000 square feet or less than 250,000 square feet. And so what we're seeing across the board, you have to have loading bays on the opposite sides of those sensitive receptors. You have to have separate entrances for those heavy duty trucks. And locate those or have the internal circulation of those trucks away from those receptors. When you're getting into the actual development of it, if you have over 250,000 square feet and it is already zoned industrial, you're going to have about 300 feet between the sensitive receptor and those loading bays. You're also going to have about 50 feet of landscape buffering.
So when we were preparing for this, you just said something that made me think of an additional challenge, that for a 250,000 square feet or 1 million square feet industrial development, managing around some of those things, certainly not as challenging and not as cost prohibitive as the smaller development. How do you think that some of these requirements affect the smaller development prospects versus just these large, 1 million square foot or more sort of industrial complexes?
So when you're less than 250,000 square feet, the development standards are less. So you're only going to have, let me go back to that. You're going to have about 50 feet of landscaping buffering if it is zoned industrial. You're going to have 300 if it is zoned industrial as well for less than 250,000 square feet. But if it's not zoned industrial, that's when you start to get to some of the changes that are most impactful. Because you're not in those industrial zones, you're going to be around these sensitive receptors. So they want more buffers. They want a greater distance between those loading bays and those sensitive receptors as well.
So it sounds like AB 98 is going to make it harder to develop in probably the areas that people would want to develop the most. That all sounds really good if you own a currently leased industrial property.
Yeah, in the short term, we should see the demand for those drive up and have the lease rates go up, or be able to, if you're selling the property, get a premium for those spaces.
Based on your answer, kind of what I heard there, maybe it's not all roses though. What concerns do you have for owners based on this bill?
I would say the long-term effects to California with AB 98 going into place, we potentially see the continuing of the exodus of businesses from California, less jobs in the area. So there could be some greater impacts down the line for the economy.
It seems like one of the things that has been our takeaway over the last week is the difference between California policies and maybe where things are going across the country. You look at some of those maps and, when they do it by county, you certainly see a lot of red and a lot of places that are a little bit more business friendly where we have seen a lot of these businesses move. Tell me if I'm correct in kind of your takeaway, but maybe one of the biggest impacts that drives business out is that they're not going to be able to locate themselves that are close to where people live, where it's easy for them to get to, where, basically where people want to work, and they're going to have to go further away. And if they can find a better alternative someplace else, maybe that's the way to do business.
Yeah, I'd imagine that's where we see things going.
Okay. Any other bills that we saw get passed in that legislative session that you think have an impact on the values of commercial property or commercial real estate owners?
Yes, I think SB 1103 is far more impactful for commercial owners.
Talk about that for a second. What is it?
So it's what people are saying is the beginning of rent control over to the commercial side. So what they want to do is they're going to have notice periods for rental increases. They're going to change the way that pass-through expenses are used, and you're going to have to provide translations for leases in 5 languages.
So you were talking about those requirements for leases. Give us a little more detail on that. And is it particular to a group or like every property? Tell us a little bit more.
Yes. So the qualified commercial tenants are the ones that this SB 1103 pertains to.
What's a qualified commercial tenant?
So there are 2 classifications. So it would be a micro business or micro enterprise with less than 5 employees, restaurants with less than 10 employees, and nonprofits with less than 20 employees.
How does an owner figure that out? I've never seen micro enterprise on anybody's business card.
Yeah, so it is interesting. And I would say this bill is not only extremely impactful, but the language within it has caused owners to have some issues. So the term restaurant is not defined. Now, when it comes to a micro enterprise, that's been defined in business and professional codes. As for nonprofits, it goes off the IRS qualified 501c3. Now, within that, the tenant will have to provide the owner through their own self-assessment that they are qualified or a qualified commercial tenant.
This sounds like PPP. If an owner has a qualified tenant or is considering a qualified tenant, what do they need to know?
So as it pertains to rental increases, if you're increasing your rent for more than 10%, you have to provide 90 days notice.
Now that's to a qualified tenant.
Yes, all the qualified tenants.
If you have a month-to-month lease for a non-qualified tenant, what is the time period today? 30 days?
Yes.
Okay. So tell us a little bit more. So you got some inability to increase the rent as fast.
Mm-hmm.
What else do they need to know?
So it also pertains to the pass-through expenses that you'll have in leases. So things like emergency repairs, insurance premium costs, or having to do improvements to the property for ADA reasons, property tax increases, even inflation adjustments. Now they're prohibiting that, or they're adding new regulations to the way that you can go about that with your tenant.
So we just heard Yvonne talk about insurance costs on the multifamily space. We certainly know that leased investment is affected as well. Is it possible that a tenant could have a lease where their insurance cost is passed through, but because it increases so much that they wouldn't have to pay it?
Yeah, the way that things are moving for these qualified commercial tenants is that they're going to have a tremendous amount of protection from the landlords.
All right, that does sound a lot like what we started to see in the early days of rent control and eviction moratoriums and no fault eviction on the multifamily side. You mentioned something about translation of leases in 5 languages.
Mm-hmm.
What's that?
So they're moving forward. If you're going to be negotiating with a tenant who English may not be their primary language, you're going to have to be able to provide them one of the 5, either Vietnamese, Korean, Spanish, Chinese, or Tagalog. So those are the 5 languages that you have to translate a lease to before you can move forward with signings or anything like that.
Your knowledge at this point, any of the widely used forms or form providers have leases translated into all those languages available?
No, not off the top of my head. I would say that that's something that causes the biggest concern for owners is the increase in legal fees and management costs associated with, translating leases and the time that it would take to go back and forth with that.
Well, you just talked about some of the feedback you've heard from owners. In the conversations you've had with owners or the tenants that we work with out there that would be covered as qualified tenants, is there widespread support for the bill?
I would say there is caution on both sides, which you wouldn't expect. But let's start with the qualified commercial tenants. For them, they're a little bit worried that through these new requirements, then they're not going to be looked at in the same lens as, let's say, non-qualified commercial tenant. I think if you're going to be, as a landlord, if you're looking at a restaurant that has less than 10 employees or a restaurant that has 11 employees and everything is apples to apples, well, then what's stopping you from moving forward with the restaurant that has 11 employees?
It does seem to make it where if you were one of these things, you might try to not be one of these things so you'd have more access to the best space.
Mm-hmm.
At one point in this thing, you had mentioned evictions, and evictions for qualified tenants are a little bit different according to this bill. Talk a little bit about that. What are the differences as it relates to evictions?
Mm-hmm. Well, to go back also to the topic of translation for these leases, that if you're not providing that translation or there is a disconnect, it gives the tenant full right of rescission. I mean, they can essentially walk away from that lease with no damages to them. And so as a landlord, if you just did a bunch of tenant improvements to the property, well, now you're out of some money for the work that you did because the tenant has the right to leave based on these new terms. But to go back to what you're just asking me, Justin, the eviction situation in California is not easy right now for landlords. And with what I'm dealing with right now with one of my clients is that he was doing somebody a favor with keeping their rent low, and things had changed, and now he was going to move forward with selling the property. We gave him a 90-day notice to the tenant in May. We then had a court date set for today, and it got pushed back to January 12th. We're now hearing that we won't have this resolved until April, and so we're working on almost 11 months from the time that we administered the notice to vacate to when it will be absolved.
It sounds like the best case of when the tenant could be out.
Yeah, I guess that's being optimistic about the situation.
Well, that brings something into light. I mean, you talked a little bit about how long-term AB 98 may push more businesses out of California. You've talked a little bit about 1103 and how that makes it harder for subtenants, but also certainly more costly. And you've talked about how evictions can basically lead to a commercial owner not being able to get their commercial property back in circulation for up to a year. That's certainly not common across the country. Let's take it now to the national level. Southern California certainly over the last 20 years has become a logistics and warehousing industrial market, moving away from the manufacturing and kind of aerospace heavy focus of the 60s, 70s, and 80s. And with the, I guess, onboarding of so many goods from Asia, we've seen like I said, the buildings just become more of a warehouse and logistics sort of market. Trump's talked a lot about tariffs and trying to bring more manufacturing to the United States. How do you think that affects the Southern California kind of logistics warehouse marketplace?
I think it's going to be good for those properties that you see that don't fit the institutional mold for logistics. A little bit low to average ceiling height, high power. It doesn't make the best logistics space, but it is perfect for manufacturing. I think we can see some increases in that sector of the industrial market, and overall, it'll just continue to grow the way it has.
What about, so from that manufacturing standpoint, like obviously people that want to be in California are going to stay in California. But if we're going to see a lot of manufacturing jobs, do you think that a lot of it will be in California, or do you think that some of this legislation is going to continue to drive businesses to more business-friendly markets?
I'm hopeful that people stay in California, but yes, I think with the way that the writing is on the wall for commercial tenants and businesses, I imagine that it's going to continue to have some businesses leave the state of California. I would encourage that all of the office, retail, industrial owners out there really listen to what Mike, Adon, and Tom have to say, because they've been dealing with this stuff with their clients for the last 10 years. Yeah. And now this is kind of the beginning of it for the commercial side. So listen to the stories about what their clients have done, take into account, because at a certain point, there could come a time where you may want to keep your equity in California, in the South Bay, but moving it to an industrial sanctuary or somewhere where that zoning is protected, it's really going to help out when you go to sell the property, or more importantly, keeping a tenant base there, more opportunities for tenants, and not having to deal with some of this legislation that's designed to separate it from the residential side, residential areas.
Daniel, great comments, and I think great advice there, because you're right. So many of the things that started other places from a multifamily side as it relates to anti-landlord legislation has just gradually worked its way into the entire California market. You mentioned we're starting to see a little bit of that on the commercial side. And there are strategies and ways where you can still get all the benefits you want, but you should be protecting yourself or putting together plans now. As Edon said, the owners that would have been hurt the most by Prop 33 passing were the ones that hadn't prepared for it to pass. And so that preparation now not only is going to put more money in people's pockets today, but is going to make their properties worth a lot more if they prepare now for those things to come. We're going to take another short break. If you've got questions, put them in the chat. But Mike Alper is going to join us next. And kind of to dovetail on what Daniel just mentioned, Orange County used to be one of the reddest places in California, if not across the country. A place where you never thought there'd be rent control or very anti-landlord legislation. There's things starting to happen in Orange County that's changing that environment, and a good indication of what Daniel's talking about, what we're seeing across California. Thanks, and we'll be right back in just a minute. Starbucks, 10-year double net lease acquisition in Bryan, Texas. Our client closed escrow on the property days before certificate of occupancy and a 10-year lease initiating with Starbucks Corporate. The property is located on Texas Avenue, which connects downtown Bryan, Texas, and Texas A&M University. Texas A&M University was founded in 1876 and is currently the largest institution of higher learning in the United States with over 72,000 enrolled students. The university is also home to over 30 SEC sports teams and the George Bush Presidential Library. Bryan, Texas, founded in the 1800s, is a unique combination of history and new development. Whether it's the historic downtown that's undergone renovations and revitalization with new boutiques and restaurants, or the suburban areas with the newest shops and retail centers, Bryan, Texas has been one of Texas's best places to live for the last few years, as more and more residents move from the bigger cities to the quieter country life that Bryan offers. Right now, I'm joined by Mike Alper. Mike's been with us 7 years. He is the regional director for Orange County for our office, specialized in multifamily, and wanted to get Mike to join us today because Orange County is changing. When you see these election results and what's happened over the last few years, it might be how different investors are casting their ballots across the country, and what happened to Santa Ana owners with Measure CC. Mike, why don't we start there? Tell us a little bit about what the measure was, and then we'll get into more detail on how it's impacting owners and is maybe the canary in the coal mine for others.
Sure. Thanks for having me, Justin. Votes across the country definitely went in the direction of deregulation, pro-business expansion, and I think growth for investors. And Santa Ana really hit the brakes and kind of took the opposite response with Measure CC passing. Really what it does is it adds the rent stabilization and just cause eviction into the city charter. So this was already passed as basically a city-specific rent control ordinance, and now it's enshrined in the city charter.
Okay. So we've had some data since the city council did pass the stricter rent control measures. How has that affected multifamily values in Santa Ana compared to the rest of OC?
Short answer is down about 20%.
All because of one bill.
All because of one bill versus the rest of OC. I was recently looking for a client that owned a couple buildings, and they were almost identical buildings. One of them was in Santa Ana, the other one was in Garden Grove, and they wanted to see the value of both of them. And really similar income stream, similar unit mix, similar year built. And the Santa Ana building was about 20% less, just because it was going to be way harder for a new buyer to go capture the upside. That upside potential was going to be harder to achieve. So from a cap rate perspective, I'd say around 4.75, 5% for a lot of Orange County, but for Santa Ana, people are having to sell at 6 caps.
Let's go back and talk about this for a second, because I think we hear a couple things when you talk to some people, and they don't appreciate how big of an impact something like that has. I mean, you said 20%, you just talked about 100 to 125 basis point differential in different areas. When an owner has long-term tenants or don't have their rents at market, talk a little bit about how it's not just this year you can only raise your rents 2% versus 8.25%. Talk about how that plays out over 5 or 10 years on the returns that somebody makes.
Sure. Yeah, we put together 10-year financial models all the time for clients, and we basically look at, here's how your building is going to perform over the next 10 years. If in Santa Ana, if you just keep raising rents by, let's say, 3%, give them the benefit of the doubt that they're going to get the full 3%, versus if you exchange into a building in, say, Fullerton or maybe City of Orange, somewhere that are kind of red landlord-friendly cities. And with just a 2% difference, we'll model in 3% rent growth for Santa Ana, and then we'll model in 5% rent growth for one of the other cities like City of Orange. It translates into a 30 to 40% difference in cash flow and appreciation over a 10-year period. So it's a massive, massive impact.
And that's the one that's probably the most visible, right? But another thing that people don't always consider, and when we do these models, it really shows up in the numbers, is what it looks like when you can only take a 1-month deposit. What it looks like when your eviction process costs 3 or 4 times as much and takes 3 or 4 times as long as it did 10 years ago. All these things can add up, and tell me if I'm wrong, but I think that an investor can tell you, okay, these are all the things I'm worried about or I've seen change. Can you show me how it affects my returns? Can you show me how it affects what I'm ultimately going to leave to my grandkids?
Oh, absolutely. And we do it all the time. We put together a 10-year comparative analysis, and we just show them, hey, if you take a total return approach and you're looking at the cash flow, the principal reduction, and the appreciation combined on, say, a bigger building in a better location versus what they have in a place like Santa Ana, we're talking usually about millions of dollars over the long term.
Certainly something that people don't think about on a daily basis because the rent's still coming in and it's kind of business as usual. Yeah. But you let too many of those days go by and you end up leaving a lot of money on the table. Daniel talked about some of the bills that recently got passed up in Sacramento starting to potentially be, or people starting to talk about those being the beginning of some form of rent control, eviction moratoriums, just cause, all that stuff on the commercial side. But of the owners you talk to regularly, how many think something like this never would have happened 10 years ago in Orange County?
Pretty much everyone thinks it never would have happened 10 years ago. I think recently, like in the last 5 years, Santa Ana owners have been a little more keenly aware that something might happen because these tenants' rights activist groups have been trying to get a city-specific rent control ordinance on the ballot. So they kind of saw it coming a little bit, but I think really everyone was shocked when that ordinance passed by city council in the middle of the night without a vote of the people.
Well, you know, I guess if you ask those same owners too, where it would happen first, they probably all would have said Santa Ana.
Yeah.
But are there other cities in Orange County that might be next?
Yeah, we look at all the cities in Orange County kind of as like red cities versus blue cities. And I think the general consensus is that Anaheim and Garden Grove will probably be next. Another one that people are talking about is Buena Park. You know, Anaheim and Garden Grove have both had these tenants' rights groups trying to get it on the ballot. And when that starts to happen, it usually doesn't go away.
That's certainly true. And, you know, when we talk about, we look at Orange County, you know, I think that the high cost of rent is definitely a driving force of some of the rent control advocacy that we see. New housing would bring more stock to the market and perhaps push rents down. What might deregulation have on developers' ability to increase density and deliver a lot more housing to Orange County?
Yeah, I'll give you an example. We were recently looking for a client at a low density motel that they owned. It was on a huge lot, major thoroughfare. And those, I think, will get upzoned with deregulation. You can kind of already see what's being built around those properties. A lot of times it's either the tall and skinny 3-story homes or townhomes, or it's a larger apartment complex with some sort of low income component. So I think we'll just see more and more of that.
Well, more development would certainly increase the stock and push down housing costs. What would it do to values?
So it depends. I think depending on the type of development, it can raise the ceiling for rents in certain areas. You know, if they build a 200 unit luxury apartment complex with a ton of amenities, that can really raise the ceiling of what people can get in that neighborhood. At the same time, I don't think that those luxury developments really compete with 50s and 60s product.
Certainly, I think that working class housing segment of the market is going to be virtually unchanged by the development that we're going to see, because over the last few years, the development we've seen has either been in the high-end luxury space or in the low-income space. And so, as you said, it might increase the average rent in the area, which might bring an area up, and adding a bunch more units isn't really going to hurt the average investor who owns a working class apartment building. So, Mike, what are you recommending to owners who ask what you think is happening and what they can best do to meet their goals?
So I always look at what the most sophisticated investors in the market are doing. Many of them are moving their equity out of the blue areas and into the red. They're looking at the red areas of Orange County as sort of a safe haven for their equity, and they think that it'll remain unregulated, more free market for longer than maybe anywhere else in Southern California. So that's really cool. Also, I'm seeing a lot of people, I think, wisely trade out of older product, 30s and 40s construction product, that where the major systems are needing a lot of basically replacements, and into 70s and 80s product. If you look at the big players, the syndicators, the money raisers, they're looking at the newer product where they don't have to make a bunch of capital improvements that aren't increasing NOI. The money that they spend on a building directly increases the NOI. So I think those are a couple of the biggest opportunities. I think anyone with 60% or more equity should be looking at an exchange and seeing what they can do.
You mentioned something about the older buildings and the capital improvements required. That for most owners that are very passive, that are busy doing something else, whether that's working or enjoying retirement, they've got to go out and hire third parties and then manage that process. That's typically a very costly proposition. But those owners can sell or trade into something that doesn't have the issues and sell those properties to people that are a little bit more hands-on operators that can get some cost efficiencies and make those upgrades and still have it be profitable for them, where it wouldn't be a profitable move for somebody who is a little bit more hands-off in their operations.
Absolutely. I think a lot of the bigger operators have economies of scale. You see these large groups where they're doing all the renovations in-house with their management team, and they make all the cabinets, and they do everything on the interiors themselves. So there's profit centers built in to their companies for doing that sort of stuff. Whereas for the mom and pop owner, it might make more sense to trade into a single story 70s construction deal down in Huntington Beach that's going to be a lot more hands off and kind of run itself.
Mike, bunch of great ideas over the 10 minutes that you joined us. Thank you for that. I think, the big suggestion of knowing what your building looks like and how and seeing how it should perform over the next 10 years, factoring in some of the things that either are happening now or will be happening that affect your income stream, both on the income side and then, as Mike mentioned, on the expense side as it relates to capital projects. And Idan and Daniel both mentioned about insurance requirements and upgrades, that you can look at all of those things today. And we've got the systems and the processes in place where we can look at exactly where you're at, where you want to be, and help you figure out the best way to get there that makes you the happiest, the healthiest, and the wealthiest. Mike, thanks for joining us. And Tom Watkins will join us here in the next 30 seconds to finish off our hour. We love to keep these things to an hour at Centennial. We are going to finish this off, joined by Tom Watkins. Tom's got over 20 years of experience. As I said in the open, covered a lot of different markets over his career. Tom, I wanted to get your perspective, maybe a little bit more national perspective. Now that we have a winner, how do commercial real estate investors feel about the results?
I think there's a big sense of relief. It was a long election season. Everybody felt it. Investors seem to be encouraged by the results. I got a number of text messages from clients the day after the election. They're excited for the new opportunities, but they're moving forward cautiously.
You're talking about opportunities and moving forward. What are they most hopeful about?
There's a couple things. I think the biggest is the 2017 tax bills are set to expire this year. So hopefully those will be extended on top of some new favorable tax bills that he may be working on. He's also got a great track record of deregulation, and he seems to be pro-development. So everybody seems to be positive and excited about the future.
You talked about the tax provisions and the Tax Cuts and Jobs Act, and a little unknown about whether that might pass. Any other concerns or things that people are expressing to you, or is it, let's fire up the engines and get rolling and get back to seeing our clients' values of their properties increase and increasing their NOIs and a bunch of wealth creation for our clients?
I think people are thinking about tariffs. I think that's on people's minds when it comes to interest rates. It's going to be good for some sectors, certainly, like manufacturing, of course. I think it'll help. But the budgets and timelines of some of these developers that have big projects, it'll be interesting to see how that affects them.
You brought up the tariffs thing, and certainly there's a pro and a con to any decision that anybody makes. And tariffs might bring some manufacturing jobs back, might do some positive things, but if it does some positive things, it's obviously going to affect people and jobs that are heavily affected by imports and exports. So I think that's we all have to accept that if there is positive and more positive to tariffs, that some segments are going to be negatively impacted. Now, California might be one of them, kind of along those lines of tariffs or Trump on one side and California on the other. Gavin Newsom came out saying that in California, we don't want Trump and we will fight him. How are investors feeling about the outlook in California compared to the rest of the country?
California, especially LA, places like San Francisco, they've always had kind of an overwhelming, ever-changing set of regulations that makes it hard to conduct business. I don't think Trump being president is going to help that very much, in my own opinion, but we shall see. It's always been a hard place to do business, excuse me, to do business, and it might get harder. Who knows?
It might, and I tend to agree with you that it certainly is always maybe harder in California. What it sure seems like is, whether it is California or it's the nation as a whole, that the wind is at our backs. And if you want to stay in California because you like it, because you're comfortable with it, because you can benefit from the legislative environment, there's going to be wind at your back as a real estate investor. If you want to look at other places across the country, whereas historically there might have been a lot more breeze in California, that level of breeze is evening out across the country. Let's kind of do that or compare the two. You work heavily in Las Vegas and in LA. What are the differences in investors' minds in those two markets?
I'm actually in Vegas right now, and it's interesting. Vegas is kind of a tertiary market, I would say. I would put it up there with Phoenix and Denver, but it hasn't been overbuilt in this last cycle compared to those other two cities I mentioned. Values are staying strong, which is a good sign, and there's a lack of new development. So I think the demand is there, and it feels like.
So when you're talking about differences, in Nevada, just went to Trump, and big swing state victory for him. But Clark County is still pretty blue. Clark County being where Las Vegas is at, and all the cities that make up the suburbs of Las Vegas. Are investors in Clark County and Southern Nevada hearing the same things as investors are hearing from government in California?
No, there's been a few whispers of perhaps some kind of rent control, things like that, but I think we're a ways out from Nevada becoming more like California.
You talk a lot with some of the largest players here in the state and really around the country. What are you hearing that they're looking for, or where maybe the best opportunities will be as the wind starts to fill our sails? And I'll talk with you about interest rates in a second, but we've had a couple drops so far. and there's optimism for that. But where in your conversations, where are you hearing that people think there's going to be the greatest opportunity?
I think they're just looking for deals wherever they can find them. I know plenty of people in Los Angeles that are getting good deals right now. Deals that I look at and say, I can't believe that traded. Same in Nevada. There hasn't been as much velocity in either market, but the deals that have gotten done through this little dip, some of them are pretty impressive. So it's really just keeping your eye on the market, having a good broker out there that knows what's going on and knows when to strike.
What do you think Trump's impact is going to be on the Fed moving forward?
I think it'll be interesting. I think the Fed's going to try to maintain its independence, at least for the first couple months, and not let him lean on him so much. As of last week, financial markets are thriving. I think we had the best day on the stock market of 2024. But interest rates are still high and they're rising. The 10 years being cut, but the banks are keeping their spread, and the true interest rate that a buyer is paying for a deal, it's actually gone up in the last 5 weeks.
And with that, you still, the overall consensus is optimism and more deal making and increasing velocity?
I think so. I do.
Awesome, Tom. Thanks for finishing off our webinar today with some great comments about what we're seeing both nationally and then in a couple of the markets you serve. With over 20 plus years of experience, you bring a lot of great insight to our clients that are trying to figure out what are the things to do and what are the best ways to make money. Thanks, Tom.
Yep. Thank you.
2 weeks ago, we were planning for 2 different scenarios. Scenario 1 included Prop 33 passing, a Harris win, and probably a lot more legislation that was not favorable for commercial real estate investors. But we've seen the outlook really kind of go from terrible to awesome in 7 days as Prop 33 failed. And as Tom just mentioned, nationally, investors are a lot more optimistic. Whether you want to stay in California or consider more options across the country, as I mentioned, investors are starting to feel the wind at their backs. And if you want to unfurl the sails and really ride that opportunity, we're hoping you do 3 things right now. Number 1, put together a strategy to make as much as you possibly can with the real estate equity that you have in your control. Things have changed, and you need to make sure your old plan is the right plan right now. As I said earlier, we want you to be happy, healthy, and wealthy. The other one, and we heard in the earlier comments, is protect yourself. If any state or if any city, or the state of California passes another anti-landlord, anti-business policy, it should come as no surprise. This includes anything that caps your ability to make money, makes it harder, or increases your costs like insurance or required retrofits. We encourage you to strengthen your investment by getting ahead of what's coming. We know what it is, and we know what the best investors are doing to strengthen their investments and protect against these things. And we're happy to share those ideas with you because we want it to be easier. And then the last one, ask us if it's possible to hit the grand slam right now. There's a lot of people that are really optimistic that this could be the opportunity of our investment lifetimes. You don't want to miss it because of complacency. For those that want more passive income or want to retire from their current job or own a ton of real estate, the opportunity might be there right now. And at least having the plan in place to accomplish it gives you the opportunity to benefit from a lot of the positive indicators out there. And then the last thing, I hope you join us 2 weeks from today. We'll take our next look at the impact of the election on commercial real estate. We're going to have more clarity on the national campaign positions that will come to fruition and their impact on your investment. The local races are going to be finalized, and I wouldn't be surprised to see that we already see the future of the market taking shape. Until then, I encourage you to reach out to us and ask, how can we help you do better? And give us the chance to prove to you what goals you can accomplish. Thank you.